When gifting assets like investments, real estate, or large sums of money, you might be finding yourself on CRA's radar. Now, although Canada, unlike the US, does not have a gift tax, before you start gifting your children all your assets in early inheritance, to avoid taxes and probate fees, there are a few things you need to keep in mind to avoid triggering unnecessary tax attribution rules. Hi, my name is Koby. If you're new to my channel, I focus on helping Canadians smartly invest their money and safely build wealth while paying fewer taxes. In today's video, which is the second one from a two-part mini-series, I will tell you what you need to know when gifting assets to family members, what are the most common mistakes, and how to avoid them. If wealth creation is something you're interested in, make sure to like and subscribe. It costs you nothing, and you'll be notified when a new video is uploaded. So let's jump right in. In a previous video, I talked about what you need to avoid when gifting cash to family in Canada. If you missed it, make sure to check out the link in the description below. Today's video will be more focused on what to avoid when gifting assets like investments or real estate. Let's first quickly explain what attribution rules are and then talk about a few common scenarios when attribution rules may apply. The Canadian system taxes individuals progressively. High income earners are subject to a higher marginal tax rate, while low income earners incur a lower marginal tax rate. A family then could potentially lower their overall tax burden by shifting income away from high tax family members toward low tax members. Attribution rules would prevent taxpayers from reducing taxes by shifting investment income to family members. Without these rules, a taxpayer could subject his or her investment income to a lower tax rate by transferring the income earning property to a low income spouse or a child. Now that we got this out of the way, let's review a few common scenarios where attribution rules may apply. The first one is when transferring an asset as a gift to a spouse at the asset's fair market value. In order to avoid future attribution rules, you need to elect that the spousal rollover rules will not apply. Once the transfer is completed, the giver of the property will need to report any accrued capital gains on their tax return, and the spouse will have to report any future capital gains on their own tax return. The second scenario is when selling or transferring a property to a family member for less than its fair market value, meaning you give them a discount. When doing so, not only you could trigger attribution rules, but if audited, CRA may decide to adjust your deemed proceeds from the transaction upward to the property's fair market value, which can trigger additional taxable capital gains, penalties, and interest. And to make matters worse, the family member, which is the receiver of the property, could still be deemed to have received it at the original transfer price and not its fair market value. The third scenario is when transferring an asset to a non-spouse family member as a gift at $0. When doing so, the family might end up paying double the tax. That's because on top of the giver paying the accrued capital gain tax, the recipient of the asset might be taxed again on that portion of the gains between his or her actual cost and the fair market value at the time of transfer, which was already reported on the giver side. The fourth scenario is when transferring property to a family member for a price that is higher than its fair market value. In this case, the family member's deemed cost might be adjusted downward to the fair market value. However, the giver's proceeds of disposition for the property would still equal to the actual selling price, which was set on the property at the time of the transfer. Now, the fifth scenario is when gifting assets to an underage family member. In this case, any income earned from the property is attributed back to the transferor. Income from the property could be in various forms, including interest, dividends, rents, and royalties. Capital gains, unlike the income, would not be attributed to the giver and would be taxed in the hands of the receiver. So, if you have assets you expect to increase substantially in value, such as shares in a corporation, jewelry, or art, you might consider transferring them to your children or a trust for your children. While any dividends will be attributed to you until your children reach 18, capital gains on the sale of the asset will not be. In any case, make sure to consult your accountant before making a final decision. That's it for today's video. I hope you found it valuable. If you want to know more ways you can do income splitting without triggering attribution rules, you can find a link to a video I made in the description below. Also, if you haven't done that already, make sure to hit the like button. And if you want to see more videos, don't forget to subscribe. If you have any questions or comments, please let me know below. I read and reply to every single one. Thank you very much for watching, and I'll see you in my next video.